Well, again, we thank you for joining us today. I'm Marlon Bowling, your tour guide to the ag commodities. I'm joined by Oliver Sloup, and he's with Blue Line Futures in Chicago for what could take place this week here.
Well, it is certainly a week that a lot of people have been anticipating, and we expect there to be quite a bit of volatility in the outside markets, and that could really spill over into a lot of commodities and the money flow. And we've already seen some of it take place over the last week. Going into the end of the month of October, we saw some position squaring from the funds who had some pretty good gains in a lot of these commodities, specifically the corn market. Friday's commitment to traders report is a bit of a lagging indicator. They showed that funds added about 57,000 contracts, but keep in mind that only goes through Tuesday, which is October 27th, which is when we marked highs. It's estimated that in the back half of the week, they sold about 57,000 contracts. So there has been some long liquidation. I wouldn't be surprised to see that continue here in the corn market if the bears continue to defend that psychologically and technically significant $4 handle.
Right now, December corn is down about 3 3/4 cents, and it's showing a trade of $3.95 per bushel. So on the intraday chart, it has been chopping around quite a bit. Maybe not as much as what the soybean market has been doing this morning. And again, you bring up a good point about those really large commodity fund positions on the long side. Likewise, on the soybeans, I see they're long 232,000 contracts on the soybeans. And we currently have November soybeans down 8 1/4 cents this morning. January down 5 1/2 cents. We're at 10.50 3/4. Oliver, the deliveries that were posted on soybeans this morning, I just wondered how detrimental that was to the trade. Is that kind of weighing like an anchor on here?
Yeah, I think there's quite a few things weighing on the anchor or weighing on the soybeans, and I think that's one of them. Also, just a big, large net long position in the grain complex itself, as you had mentioned. Funds are net long about 233,000 contracts as of last Friday's commitment to traders report. That goes, again, through Tuesday, October 27th. It's estimated that Wednesday to Friday funds were liquidating about 24,000 contracts. So it looks like they are starting to square things up a little bit. We're hovering right around that psychologically significant 1050 level. If we really failed to get any more momentum back out above here, I wouldn't be surprised to see that long liquidation continue. And there's really not a whole lot in the way of technical support until you get closer to that 1020 area, which was a big breakout point just a short while ago.
On the soy meal, I did want to touch on that as well here on the soy components. You have December 60 cents lower. We're at 378 even per ton. On the soybean oil trade here this Monday morning, we are down 25 points on December futures. We're at 33.36 per hundredweight. Let's move on to check on our wheat. And here, the commodity funds were net long in Chicago, 48,896 contracts after they sold about 800 last week. Kansas City, they are long 41,000 contracts yet. The December Chicago wheat right now 6 3/4 cents higher at 605 1/4 after dipping down to 591. So very choppy action here in this wheat market today. The Kansas City market has December up 11 1/4. We're at 552 1/2, and that's still 17 cents off of our overnight low. Minneapolis spring wheat trade currently has December 5 1/2 cents higher at 557 3/4. What was it that took the spurs to the wheat real quickly?
Well, I think getting a little bit of relief. We saw the Chicago wheat contract finish about 34 cents lower for the week, so we're getting a little bit of reprieve here. We'd be looking to resell a relief rally 615 to 620 with the idea that a potential head and shoulders formation would be taking place, and that would be relatively bearish here for the wheat market.